Hello and welcome to the Stockout. Happy Friday. The Stockout is your show at FreightWaves about CPG companies, supply chains, and CPG companies' supply chains. I'm your host, Mike Baudendistel of FreightWaves. And today I'm going to be taking you through two CPG companies that may go public. We learned, got some more information about that this week. Those are The Honest Company. That's a company that was founded by actress Jessica Alba, and Impossible Foods, which I've talked about before, but I think it really sort of plays into this whole theme of plant-based substitution for animal-based products. And also talk about two companies that have long been public that reported earnings this week to sort of kick off the earnings season, those being Pepsi and L'Oreal. And if you're just finding your way here and wondering what a CPG is, maybe you were looking for a Dooner and took a wrong turn. CPG are consumer packaged goods. Those are consumable products and pretty much whatever you would buy at a grocery store or big box retailer, things like food, beverages, cosmetics, personal care items, those type of things. But before I get into those companies, a word from our sponsor, which is Echo Global Logistics, headquartered in downtown Chicago. Trust the experts at Echo Global Logistics for all your freight transportation and CPG shipping needs. Whether you are a Fortune 100 company, Fortune 100 CPG company, or a specialty food manufacturer, Echo has solutions to fit your needs. With their dedicated team, as well as Echo Ship, a self-service shipping portal allowing you to quote, book, ship, and track, Echo has you covered. Technology at your fingertips and experts by your side 24 hours a day, 7 days a week. To find out how Echo can simplify your transportation management, please visit www.echo.com/CPG. Please do that today. So thanks to our sponsor, Echo. And with that, I'll get into my topic of the week. The thing that I found most interesting in the CPG world this week was an SEC filing that came out from The Honest Company, which was a company that I was not familiar with, although asking around my family, I probably should have been familiar with this. This was a company that started 10 years ago by actress Jessica Alba of Dark Angel fame, and I think in the Fantastic Four, she played Susan Storm. So it was actually a filing, not a SPAC. This is going to be a traditional IPO where an SEC filing, and it was more personal than I think I've read an SEC filing before. She sort of goes through why she started it. She had terrible allergies as a kid, and that sort of came back to haunt her 10 years ago or so, and she became a mother. At a baby shower, she got a product that gave her an allergic reaction, and she sort of set her on this entrepreneurial path to start a company that did not use the type of chemicals that would give one those type of allergic reactions, and started out just selling baby products, which are still the bulk of the revenue, sort of diapers and wipes, and then has since transitioned into both other categories of personal care products, as well as expanding the target demographic, which started out as women that were 25 to 35, and that were sort of relatively upper income to afford more expensive products, but trying to expand upon that. And over the years, the company has had a lot of what I would call ups and downs. But last year was a great year. The revenue was up nicely, and it's about 300 million in revenue. I think it was up 28% last year. So they just filed their S1, planning to go public, and I can take you through the bull case and then also some risks. And I think this is an important one to monitor, even if you're someone that participates in the CPG industry through a much larger company, because it gets to the question of, can a small startup sort of compete with these larger CPG companies? You think of those categories that I mentioned, and who else competes in those markets. There are a lot of the biggest CPG companies. There are companies like Procter and Gamble, Kimberly Clark, Unilever, et cetera. But in this SEC filing, they went through a lot of things that I think could make you more optimistic that this company has sort of room to grow. And part of the reason they're going public is for the additional capital, and sort of the plan is to quote spend to grow. So they're some of this the strategy is they've built this loyal following. Jessica Alba has, I think they said, 39 million followers, and most of the marketing has been through social media, just people who followed her. And they're planning to roll out a more professional, more conventional advertising campaign. The brand awareness, by their estimate, is only about 25% based on surveys. And this category, this company has built a very loyal product category with about 90% of the company's diaper buyers, which are the original product category, interested in buying other things, and only about 2% of the revenue is outside of the U.S. So there's a number of ways where they think they can expand into adjacent markets. And this segment is growing faster than most. And the segment that they're targeting specifically are, quote unquote, better for you products that are, natural materials that don't have chemicals, those type of things. They say those are growing about 16%, versus about 2% for the conventional, large companies that are participating in those markets, which 2% sounds about right, given, those products in general shouldn't grow too much faster than the rate of population growth, which is somewhere around there in the low single digits. It's worth pointing out that the company hired a CEO about 3 or 4 years ago that runs the day-to-day operations. We can still see the influence of the founder on their website. They say like Jessica's favorites and all of those things, very much sort of the public face of the organization to the consumer. But it is professionally run. As a CEO that came from a long career at Clorox. He was the COO of Clorox. So just one of those big companies that this company competes against, either directly or indirectly, depending on your perspective. And look through his profile, looks like the sort of the real deal. And part of the reason they brought that CEO on was to make this truly a multi-channel company. That omni-channel is a big phrase that's being used in transportation and logistics right now. These companies want to have, of course, presence in the store when you go into the store, but they also want to have a big retail presence. This particular company, the Honest Company, they do about 30% of the revenue from their own website, Honest, but and about 55% in total, about 45% from people who go into retail stores, which is also gets to how this company can find an opportunity to expand, because they have 40% what's called all commodity volume, ACV, which is an important metric in the CPG industry, which basically means that of the relevant retailers that a potential customer would go to, this product is in about 40% of those stores by revenue. So they do well with Target as their biggest retailer that carries them. Also Amazon would be the second, going into that online space, and then they have a small presence with Costco, but that leaves a lot of the big retailers that they haven't touched. So there's a lot of ways for this company to grow, but it's probably the most compelling thing is just going into some of these other categories, taking their existing customer base and sort of leveraging that, in addition to building the brand awareness with the big advertising campaign. The biggest risk that I see to this company is, as I mentioned it sort of at the outset, is that they're competing against much larger companies, the Procter and Gamble's, the Kimberly-Clark's, the Unilevers of the world. Those are companies that the Honest Company is never going to be able to compete on with price. It simply is never going to have the scale, and is probably never going to have the same degree of brand awareness as those larger companies. So it is a little bit of an uphill battle. But I think this IPO is going to be watched closely. This is one of the first that I can think of, at least, the sort of lifestyle brand, if you want to call it a lifestyle brand, and one that the celebrity founder contributes a lot to it, and it's also one that is comeback story. This company, I mentioned, it has 300 million in sales. It also had about 300 million in sales a few years ago in 2016. So it has not been a straight shot up. It's been somewhat volatile and hampered by some litigation over the years, and those litigation complaints really went to the heart of what this company is supposedly all about, which making claims that these products weren't as naturally as they were made out to be, that they did have chemicals when they claimed that they did not, those type of things. And then the third risk that I see, the company's not yet profitable, has not demonstrated an ability to be profitable in the 10 years that it's been out there. Now, that's not unusual for a young company and a company that's investing, and it may be even have a greater loss when they start spending more for advertising and marketing. But nevertheless, the company did cut their loss in the last year from a $30 million decline to a $14 million loss. So from negative 31 to negative 14. So still taking lots of steps in the right direction with that growing revenue. And the big improvement over the last year, I think, was probably the impetus for deciding that now is the time to take this company public. It usually does take a few months for IPO to come to fruition. So this is a potential IPO, sometime maybe this fall. So definitely one to watch in the CPG space, the Honest Company. The other company that there was news about that may go public and is Impossible Foods. Now, Impossible Foods is one that I've followed closely, and it was one of the first stories that I wrote about for the Stockout, and it was one that I think is just a real mega trend in the CPG space, is the substitution of animal-based products for plant-based products. Lots of motivation for that. One of the biggest is environmental concerns. There are people concerned about animal welfare. There are others that are just simply want to be healthier. Impossible is the one in the middle there on that graphic, the one that looks, in my view, the most like actual ground beef. I think it tastes the most like actual ground beef. So I think they're ahead with the with the technology there. They have a formula that instead of using animal-based meats, they're using things like soybeans. Some of the others use things like pea protein. So the companies are growing quickly. In the past year, the plant-based meat, which they're trying to expand the definition of meat, grew about 40% in 2020, and that's in a strong year for meat, where overall meat was up about 21%, and Impossible's closest competitor was in certain quarters was growing over 100%. Beyond is their closest competitor, and they have expanded more into adjacent things other than hamburger patties. There's things like the Beyond meatballs, and Beyond has done all these partnerships with retailers in addition to a lot of these fast food joints like McDonald's and Yum Brands. Yum Brands owns a portfolio of fast food restaurants. So we're going to see a bigger presence in that coming later this year. But sort of the news out this week was that, according to people familiar with the matter, Impossible could go public later this year, either via a traditional IPO or a SPAC. And there, I think they would get plenty of backing if they did a traditional IPO. It's just a question of, do they want to get it out quickly, which is one of the advantages that that SPACs have to offer. But they've taken a different approach than Beyond Meat, at least so far. It's not quite as broad of a product category as what we've seen with Beyond, but that could change with additional capital coming in, potentially coming into the company, that they could expand to other product categories. Some of the news outlets are saying this could be valued. It could be a deal that's valued over $10 billion, up from $4 billion in the 2020 funding round. If you look at where some the main comp is trading, which is Beyond, ticker BYND. I just pulled that up on Koifin. Looks like it's trading about 15 times price to sales, which is quite a multiple. And so some investors are very bullish on that stock. There's also some that are certainly taking the other side of the trade. I think at one point the Beyond had a 38% short interest, so it's almost as high where you think that Beyond could have been the next meme stock, a la GameStop, because you could get into a short squeeze. But so it's one, I don't think the market's necessarily figured out this category, but what's clear is that demand for plant-based meat is improving quickly. The technology for how this tastes, looks, and feels is improving to the point where it's getting closer to being at parity, with traditional meats. And believe it or not, plant-based meats are now 2.7% of meat that is being purchased at grocery stores, and that's pretty remarkable considering it's a brand new category, and a lot of people are either not aware of the products yet or have not yet tried them. So those are two CPG companies I think to look forward to potentially investing in them later this year. A couple that you can invest in right now are L'Oreal and Pepsi. Both of those companies reported this week, and fortunately for me, they mentioned their supply chain. Now, supply chains with CPG companies are sometimes when they mention their supply chain, it's either in the context of something went wrong and this is why we didn't do what we thought we were going to do, or we're going to improve our margins and we're going to do that by from some nebulous comments about we're going to improve our supply chain. But L'Oreal was talking about their supply chain, but not really in the context of making excuses, because overall, companies performing amazingly well, better than you would probably would expect. So their revenue was actually up 10.2% year over year in the first quarter that they just announced, which is growing 2.5 times the market growth rate of 4%. Now they're in a lot of different categories. That that's the world's largest cosmetics company. So it's not just makeup. It's all manner of skincare and those things. And one of the things that they mentioned as really helping them in the quarter was yes, their skincare products, which are up over 20%, and they attribute that in part not only to having good products, but to customers that are concerned about maskne, which my copy editor made me define what that is. That's mask acne as a result of wearing a mask. So that's actually helping L'Oreal's bottom line. And what's also helping L'Oreal's bottom line is their growth into China. Their revenue is up 38%, and so L'Oreal's shares are at near an all-time high. Sort of at the market's also at an all-time high. But this can be thought of as a play not just on people coming out of their house and buying more cosmetics as they go to parties, but also just on the emerging Chinese middle class. People that have risen up are no longer at a subsistence level. They have some discretionary income. I think this is you can make a good case that this is one thing that's really going to benefit company that's going to benefit from that, with Chinese consumers having more just disposable income. And the CEO has gone as far as to say that he's expecting a global makeup party as COVID subsides. So, and sort of compares it to the roaring 1920s, which was a boom year for things that were not necessities, including makeup. And so the support for this, it's hard to tell how consumers are going to behave in the coming months, in the coming year. But looking at some countries where they have done a little bit better or a lot better with COVID, Israel and China. I already talked about China, but Israel, their makeup grew 43%, and the luxury component of that grew 80%. Year over year in the first quarter, and Israel's pretty much far along, I think, on vaccinations. I don't think they ever had it as bad as here with COVID. It is a smaller market, so it's a small market to necessarily extrapolate how consumers are going to behave that way in other parts of the world. But I did think that was interesting. As far as their L'Oreal supply chain is going, when they talked about their supply chain in the U.S., it read very much like a roll call for a lot of the issues that we've been talking about on FreightWaves.com. They've had issues with port congestion. They had issues with the Texas winter storm, with rising freight costs, with securing enough packaging. There you're looking at a graphic of the outbound tender volume index in blue for Dallas, Texas, and outbound tender rejection rate for Dallas, Texas. So in blue is a measure of demand for transportation services, and in green is the measure of relative transportation capacity. When that green line goes up, it means that it's tight. It means that shippers are having a harder time finding trucks to haul their freight. And you see what happened in late February in Dallas. Both of those things shot up, and it really has not corrected to where it was, and really that's true of a lot of states as well. So. But what was also striking with L'Oreal's comments on their supply chain is that these issues have been really primarily concentrated in the U.S. I mean, outside of the U.S., they really haven't had this sort of the same degree of issues. And then, of course, all of these things have led to stockouts, to certain products not being available, and some of those are higher margin products. Another thing that cosmetics companies are dealing with now is refrigerated transportation, which is at a premium. When we look at our tender rejection rates, you think of a tight market as being having a tender rejection rate of over 10%, whereas tender rejection rate in refrigerated market is mid 40%, and it got up to be over 50%. So cosmetics often need to be refrigerated, and it's very expensive freight, sort of pound for pound, and it's needs to be refrigerated because spoilage would be a big waste, and just like electronics, I sort of put cosmetics in the same category as electronics, where sometimes it's under temperature control just because it's valuable, and the shipper, the beneficial cargo owner, just does not want to take the risk of it spoiling, particularly if it's a longer length of haul. So L'Oreal, let me know if you're on board with the upcoming global makeup party. Moving on to Pepsi. So Pepsi, I think, is a company everyone's familiar with. They own Gatorade, they own Quaker Oats, they own Frito-Lay, they own Monster Energy drink. They own, they do. If you ever heard of Starbucks, that comes in a pre-made, container, like a glass frappuccino or a double shot. That's actually a Pepsi product. So their performance was mixed during the pandemic. Unlike a lot of other CPG companies, some CPG companies were unequivocally helped by the pandemic, people staying at home, eating more at home. Others were hurt, like Coca-Cola, which does a lot of business, when people go outside of the home. But it was mixed for Pepsi. They had components of both of those things. I think the drink business was hurt by people staying home, but I think the snacks business and Quaker Oats benefited from people staying home and eating breakfast at home and snacking more. And sort of one of my main takeaways from their earnings was that people aren't yet willing to give up their snacks. So the Frito-Lay business, snacks are still up 3% year over year. Quaker Oats might be beginning to slow their revenue, and that segment was only up 1%, year over year. It'll be interesting to see if that goes negative in the coming months. One of the things that I think is most interesting, during that earnings report is there was one analyst I thought asked a really astute question. He asked, Pepsi about their, inflationary pressure, and that's the topic I've talked a lot about. But they asked, specifically if Pepsi will have a competitive advantage in the inflationary environment, given that in past cycles, Pepsi has been more hedged on their input costs than most other companies. And if that's true, first of all, was that true? And if it is true, does that mean there is likely to be more consolidation in the space where the inflationary pressure hurts other companies more than it hurts Pepsi? So Pepsi can acquire some of those weaker companies, and didn't talk about M&A as you would expect on an analyst call like that out of the blue, but did seem to agree with the premise that they have what they call hedges that are structurally elongated. Structurally elongated was the phrase they use, and so that means input costs rise. That is going to impair pressure Pepsi's costs as well as in addition to everyone else's. It does take longer though for that to hit Pepsi's margins and their bottom line, and so that does give them a competitive advantage near term. So it seems like of the companies that I've talked about, of the CPG companies, this has been one of the ones that's been sort of the most prepared for this type of inflationary environment. They also added that no commodity counts for more than 10% of exposure, which is something that you worry about with soft drink makers. You think about, the price of corn has really skyrocketed, and they use a lot of, corn syrup, other, types of, ingredients have also risen. I mean, and some of the, CPG companies like General Mills, I mean, they've said that inflation is completely across the board. There really isn't any, ingredient or input that is down, and that includes things like, packaging. But so all those things considered, I all those things considered, I thought that the company's outlook for 2021 was solid. It said, mid single digit organic revenue growth and high single digit earnings growth. And so, with earnings growing faster than revenue, that implies there's not going to be any margin pressure. And in fact, you could have actually an increase in margin. And then another thing that could support their margin growth is an increase in the single serving beverages. So think of the things that you pick up at a convenience store or gas station. That's just one bottle of Pepsi. Those are some of their higher margin products. So they seem to be in pretty good shape. And as far as their supply chains go, those are back to normal. They did struggle with the winter storm in Texas. They have a lot of manufacturing and distribution facilities in the South, but most of those, they said, are pretty close to being up and running and back to normal. So things in general going well for Pepsi, I would say, in addition to L'Oreal, and we'll see what happens with those IPOs. That's really what I wanted to go over this week. Next time I'm going to dig deeper into some of the carriers' results to give you a sense for how they're doing, and did see that Martin Transportation just reported. That's the biggest, or at least the only publicly traded reefer carrier. There's some ones that are that size or larger on the private side, but that gives you sort of a unique insight because it's the only public carrier that specializes in refrigerated. So I can talk about that next week. If you would like to get my twice weekly newsletter, please go to www.freightwaves.com/the stockout. And please sign up for that. And that'll give you my contact information. And feel free to drop me a line anytime if you have things you want me to discuss. But hope everyone has a good Friday. And that's all from me. Thank you.